Welcome back to smarthelping.com. What are we doing today? Well, as you know, I've had a software as a service, aka recurring revenue, um, business model that I've had. I've done about 3 or 4 updates on it. This will be version 1.4 once we're done. Um, but basically, I'm going to go through kind of a general overview of the assumption tabs and then show you what I'm going to update. And I think basically 99% of the people that I've talked to with this want a change, so I'm just going to make the change on the whole model. This version will still be available if you want it, but the new version is going to be the default. So how this works, you got your year here, year 1, 2, 3, 4, and 5. You have your starting subscriber growth, which you could put at whatever you plan to start with, and then how much you want to grow that per month by year. And then you can also do how much you think that's going to churn per month by year. So this is saying year 1, we're going to grow at 15% a month. Year 2, we're going to grow at 20% a month. Year 3, we're going to grow at 10% a month. And then churn, year 1, we're going to lose 10% of our total subscribers a month for this subscription level. Then we've got monthly revenue per account. So what's your average, revenue per account per month by year? So we've got that going up from $20 to $40 in year 1, 2, 3, 4, and 5. Obviously, all these will be whatever they'll have to fit your product base, or what you plan to do. But it's been set up in a way, structured in a way where it's simple enough to where anybody could use it in a general way, but it's complex enough to give you some dynamic functionality over the course of 5 years. Which most people do, 5-year business plans, pretty standard for startups. Okay, so those are the revenue assumptions and the subscription levels. Next, we have the cost assumptions, and this is where I'm going to actually make the change, which I haven't done yet. I'm going to do that right now, and I'm about to pause the video. But the old way is the costs were calculated as a percentage of revenue. So I think cost of sales could stay the same, because that's actually pretty standard to know, what are basically what's your gross margins, or what are the gross margins of the industry standard. Either way, it's pretty easy to figure that out. So whatever you put in here is going to be your actual cost. So if you have 80% margins, your cost is actually as a percentage of revenue is going to be 20%. Which means, say, if you make $100, your cost of goods sold is $20. That's 20% of 100, and then you're left with $80 after cost of goods sold, or $80 of gross profit. So we'll keep that as a percentage, but then everything else is going to be a hard-coded number. So executive salaries, year 1, 2, 3, 4, and 5. So you can just add up all your executives for each year, what you plan on having in there. And this is going to be on a per month basis. So if I had 3 executives paying them $5,000 a month, then in year 1 I would have $15,000 in that box to account for that. Salesmen, same exact thing, same exact logic. Customer service, marketing, R&D, administrative, and then corporate tax rates. Just, it is what it is. So that's the main thing: is administrative, R&D, marketing, and customer service, salesmen, and executive salaries will all be, you're going to be able to hard code in the numbers instead of having to try to figure out what percentages. I just have gotten too much feedback saying that that's what they want, that's what everybody wants, and I think it is a little bit more, it's a bit easier in your head to do it that way. So that's what I'm going to do. So I'm going to pause the video now and make that update to this model. Stand by. Okay, and we are done. So now you can see you enter monthly expenses as a dollar amount by year for all of these different categories, and we get it to show up right in here. And now it will be easier for the user. Now I added on the monthly a gross profit dollar amount and gross profit margin, I did have this on the annual already. But the basic premise is, look, you can see this is, you can have up to 4 subscription levels with churn and growth rates and changing average monthly revenue per account. That all adds up. You can see the changes in each one individually by year and by month. This is just the annual view. You can see a consolidated version of the subscribers, and the revenues. Then we've got all the expenses, cost of goods sold, expenses, and then we have cash flow. Now I have added metrics such as customer acquisition cost, and we've got customer acquisition cost payback, which is saying how many months is it taking you to pay back the acquisition cost based on your, basically it's based on what your gross profit is of an account, and then what it's costing you per account, and say 14 months it takes to pay that cost back. Generally, you want to get around that 7 to 8 level. That'd be good. Anything lower than that's obviously great. Now, one other metric I was thinking about adding is lifetime value, which would be done by taking the, the retention rate percentage, and then based on that, so say you have an 80% retention rate, or and basically that means you're losing 20% of your total group. That basically means of all your subscribers you have right now, they will last for 5 years. So you would do their gross profit of the account times, well, if it's per month, you do times 12 times 5, and there's your lifetime value, non-discounted. You could also discount it and get a customer lifetime value. But the calculation, to me, I mean, I guess some people like it, but I think it's more important for the, if you're using this model, to figure out how long is it taking you to pay back the cost of a customer acquisition, and what do you need to do per month to get to the subscriber level you're looking to get to for each of your products. That's it. And then you can see all the rest of the numbers play out. Also, I did a valuation. Just says it's basically you've got your run rate, which is your annual recurring revenue, times a given multiple, and there's your value of that. Now you're going to have to research. All different SaaS businesses have different multiples, so you'd have to figure out what would fit you best. And then this is saying, this is giving you the run rate of each year based on all the information and assumptions you've entered. We've also got financing here. If you have no financing, you can put 0. And that all flows into the 5-year monthly. You can see there's none there. Put it back to 100,000. And there. And then, I mean, the other thing is this kind of gives you a nice cash flow plan. You can see how many months it's going to take you to get positive, given your what you're burning a month, and then how your subscribers are growing. You can also just see how long it takes you to generate X amount of cash if you got a given startup cost in the business. You definitely would want to know that. Alright, well, that's the update. Basically, the most important thing you need to know is just the cost assumptions have been updated. And I think that's going to help everybody. Alright, have a great one. This is smarthelping.com doing Excel financial models.